Tuesday morning, October, a kitchen in Dayton, Ohio. Adam Kowalski is 67 years old, and he's standing at his counter in a flannel shirt he's had since before he retired from the plant, holding a coffee mug that says "World's Okayest Fisherman." The light is coming in low and gold through the window over the sink. There's a radio playing low in the background, some AM station doing the news. Adam isn't listening to it. He's got a letter in his other hand. Manila envelope, Social Security Administration return address. He opens it the way you open something you think is routine. Cost of living adjustment notice. He's gotten one every year for 6 years. He starts to fold it back up. Then he stops, because this one is different. This one has a paragraph he's never seen before. A paragraph about benefit recalculation and prior offset removal, and a number next to his name that doesn't match what he's gotten every month for the last 6 years. Adam doesn't know it yet, standing there in his kitchen with his coffee going cold, but the rule book that governs his Social Security check just got reopened, and nobody sent him a memo explaining what that means for his money. This is not hypothetical. This is happening to people like Adam right now, today. While you're watching this, here's the sentence you need to sit with. Congress just changed who gets paid, how much they get paid, and how that money gets taxed, and the agency in charge of telling you about it is going to let you find out the hard way, through a letter, alone, at your kitchen counter. This system was not built to protect you. It was built to look neutral while it quietly moves money out of your pocket. Over the next 30 minutes, I am going to show you exactly what changed, exactly what it cost you if you do nothing, and exactly what you do to protect yourself before the window closes. Before I go further, hit like on this video right now. Not because I need it, because the algorithm needs it to know a human being cared enough to stop scrolling. Every like tells the platform this content matters to real retirees with real money on the line. This is an act of resistance against a system that profits from you staying confused. Let's go back to Adam. Before all this, Adam's situation was simple. He worked 31 years at the plant, paid into Social Security the whole time, but he also picked up a decade of part-time work for the county, work that was covered by a public pension instead of Social Security. For years, two provisions buried in the Social Security Act, the Windfall Elimination Provision and the government pension offset, reduced what people like Adam could collect, because he also had that public pension sitting in the background. In January 2025, Congress passed the Social Security Fairness Act and repealed both of those provisions. That's real. That happened. Millions of retirees like Adam were told they'd see their full benefit restored, plus retroactive payments back to January 2024. Here's what nobody explained to Adam at his kitchen counter. That retroactive lump sum isn't free money. It's taxable income, and it can land on him in a single tax year, which can shove him straight through thresholds that have not moved since 1984. Walk through it with me. The IRS decides how much of your Social Security is taxable using something called provisional income, your adjusted gross income, plus any tax-exempt interest, plus half your Social Security benefit. For a single filer, if that provisional income crosses $25,000, up to 50% of your benefit becomes taxable. Cross $34,000, and up to 85% becomes taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. Those numbers have never been adjusted for inflation since Congress wrote them over 40 years ago. That's not an oversight. We'll get to that. Now Adam gets his retroactive payment, call it $14,000 in back pay, landing in 1 year, on top of his regular benefit and a small pension. That lump sum alone can push his provisional income past both thresholds in the same year. Suddenly 85% of his Social Security benefit, money he already thought was his, already budgeted, already spent in his head on his granddaughter's wedding, is sitting in the taxable column on his 1040, reported through the Social Security benefits worksheet in the Form 1040 instructions. That's layer 1. Layer 2 is Medicare. If Adam's modified adjusted gross income for 2026 crosses $106,000 as a single filer, or $212,000 married filing jointly, he trips IRMAA, the income-related monthly adjustment amount, and his Medicare Part B and Part 500 premiums jump, automatically based on income from 2 years prior. A one-time spike in income from a retroactive Social Security payment can follow him into higher Medicare premiums for a full year, even though the income was never going to repeat. Added up for Adam, additional federal tax on the newly taxable 85% of benefit, potential state tax exposure depending on where he lives, and a possible IRMAA surcharge bump on a $14,000 retroactive payment stacked onto his existing income. Adam could be looking at $3,000 to $4,500 in additional federal tax alone, plus a Medicare premium increase that could run another $800 to $1, $200 for the year. Call it $4,000 to $5,700 in total damage from a fix that was supposed to help him. And if he doesn't manage the timing on any future retroactive adjustments or account withdrawals, that damage compounds every year the thresholds stay frozen. Now, I want to hear from you directly. Comment below and tell me, did you get a letter about a benefit recalculation this year? Did anyone tell you it was taxable before it hit your bank account? I read every single comment. This comment section is the field hospital for people getting blindsided by this right now. The villain here is not a person. It's a design choice, written into Section 86 of the Internal Revenue Code back in 1983, when the Greenspan Commission was scrambling to keep Social Security solvent. They set those $25,000 and $32,000 thresholds and never indexed them to inflation on purpose. Every year that goes by without Congress touching those numbers is another year more retirees get pulled into taxation, because their incomes rise with inflation and cost of living adjustments while the thresholds sit frozen in 1983. The Congressional Budget Office and multiple think tanks on both sides have flagged this for decades. Nobody fixes it. Because the federal government collects tens of billions of dollars a year in tax revenue directly attributable to those frozen thresholds. Every year Congress doesn't act is a revenue decision, not an accident. Send this video to someone right now. You know who it is. It's the widow down the street who just started collecting her late husband's benefit and has no idea what survivor benefits do to her tax bracket. It's your brother-in-law who keeps saying, "I'll deal with the tax stuff when it happens." It's the guy at your church who just got his own retroactive WFP repeal check and is already planning to spend every dollar of it. Sending this video to that one person today could save them thousands of dollars in taxes and Medicare surcharges they don't see coming. Strategy 1. The timing split. If you're expecting a retroactive Social Security payment, talk to a CPA before it arrives about whether you can manage other income in that same tax year, deferring an IRA withdrawal, delaying a Roth conversion, holding off on selling an investment to keep your provisional income from stacking on top of the lump sum. In Florida, with no state income tax, this is purely a federal and Medicare play. In Ohio, you're also managing state tax brackets on top of it. In California, you're managing all three layers plus one of the highest state tax rates in the country, so the timing split matters even more. Strategy 2. The qualified charitable distribution. If you're 70 and a half or older and taking required minimum distributions from an IRA, you can send up to $105,000 directly from your IRA to a qualified charity in 2026, and that money never counts as income at all. It doesn't touch your provisional income calculation. It doesn't touch IRMAA. In Ohio, this is a straightforward move through your custodian. In Florida, retirees with large IRAs use this constantly to keep Medicare premiums from creeping up. In California, high earners stack this with other deductions to stay under IRMAA cliffs entirely. Strategy 3. The Roth conversion ladder, done before the trigger. If you know a lump sum or benefit change is coming in a future year, convert traditional IRA money to a Roth in the lower income years before it hits, in controlled amounts, so future withdrawals don't add to provisional income at all. This takes coordination with a CPA and a specific Form 8606 filing every year you convert. In Ohio, retirees often do this in the years right after retiring but before Social Security starts. In Florida, no state tax means the entire cost of conversion is federal only, making the math cleaner. In California, you time conversions around years with unusually low income to avoid stacking into the state's steep upper brackets. Strategy 4. The withholding correction. File a Form W-4V with the Social Security Administration to have federal tax withheld directly from your monthly benefit, so a tax bill from a benefit change doesn't blindside you as an underpayment penalty in April. This is a 5-minute form. Every retiree affected by a recalculation should have one on file before their next check arrives. Strategy 5. The professional review. If you received any letter referencing benefit recalculation, retroactive payment, or offset removal, get it in front of a CPA or an enrolled agent before you file, not after. Bring the letter itself, your prior year's tax return, and your current Medicare premium notice. This one conversation is the difference between Adam finding out about his tax bill in October with time to plan, or finding out in April with a bill he can't move. Save this video right now. Bookmark it, add it to a playlist. Call it whatever you want. Social Security survival works fine, because when your letter comes, when your CPA calls, when Medicare sends you a premium notice you don't understand, you are going to need to come back here and find the strategy that fits your specific situation. Here's your window. The 2026 tax year is when a lot of this retroactive Social Security Fairness Act money is finishing its way through people's returns. The thresholds for taxation and IRMAA are not moving. Congress is not indexing them. Every year you wait, inflation pushes more of your income into the taxable zone, and the system gets more automated, more aggressive, and less forgiving about mistakes. The window to plan around a retroactive payment or a benefit recalculation is before it lands, not after. Like this video. Subscribe to this channel and turn on the bell so you don't miss the next trap they're setting. Comment below with your specific situation. I read every one. Send this to one person today who needs to hear it. Save this video to your library so you can find it again when the letter shows up. Adam Kowalski didn't get a warning. You just did. This is the retirement insurgent. Stay angry, stay informed, and don't let them take a dime you didn't agree to give up.